Two 30-year-olds walk out of the same insurance office, same day, with the same $500,000 of coverage. Tara's paying $30 a month. Walt's paying $470 for the same payout. And Walt's not stupid. He was told his policy builds wealth. So let's actually run 30 years of math on that, because the gap at the end is bigger than most people's entire retirement account. Okay, quick basics first. Term life is pure insurance. You pick a window, 20 years, 30 years. If you die inside that window, your family gets paid. If you don't, nothing. No refund, exactly like your car insurance. And that's exactly why it's cheap. Tara is 30 and healthy, so $500,000 of coverage costs her somewhere between $30 and $40 a month. Whole life is coverage that never expires, with a savings account glued to it. The industry calls that part cash value. Same $500,000 of coverage? About $470 a month, 15 times the price. The pitch is that all that extra money is building wealth. Okay, let's follow the money and see. So where do Walt's premiums actually go in those first few years? Well, a big chunk goes to the person who sold him the policy. Whole life commissions often eat most of the entire first year of premiums. That's why his cash value starts at basically zero and crawls for years. When it finally does grow, it grows slowly. The guaranteed rate is around 2%, maybe 3 or 4 with dividends if it's a good policy. And if Walt gives up and quits in the first 10 years, he'll probably get back less than he put in. Here's the stat that should stop you cold. Most whole life policies get surrendered, or just lapse, before anyone ever dies. Most buyers never receive the thing they were paying all that money for. Oh, and there's a clause in there almost nobody reads. Standard policy. When Walt dies, his family gets the $500,000. The cash value, the wealth he spent decades building. The insurance company keeps it. It doesn't get stacked on top. And while he's alive, if he wants to touch it, he can borrow against it, paying interest on his own money, or surrender the whole policy and lose the coverage. Some wealth. Now Tara. She takes the $30 policy and invests the difference, $440 a month, into a plain, boring index fund. Every month, on autopilot, nothing clever. 30 years at an 8% average, and that's roughly $650,000. More than the death benefit itself, except she's alive, and it's hers. Put them side by side at age 60. Walt has paid about $169,000 in premiums, and his cash value, if the dividends actually showed up, sits around $250,000. Tara paid about $11,000 total for her coverage, and she's holding roughly $650,000 that she fully controls. Same monthly money out the door, a gap of roughly $400,000. And that's not a trick. That's just what happens when a 2 to 3% product races an 8% market for 30 years. And here's the part the sales pitch never gets to. At 60, Tara doesn't even need life insurance anymore. The kids are grown. The house is paid off. The portfolio is the safety net now. She didn't lose by outliving her term policy. Outgrowing the need for it was the whole point. So if the math is this lopsided, why is whole life everywhere? One word: commissions. Selling a whole life policy can pay an agent many times what a term policy pays. That's not a conspiracy, it's just how the incentives are wired. But it does mean the person recommending it is not a neutral referee. One question cuts through all of it. How do you get paid on each of these? Ask it and watch what happens. Now, honestly, there are real cases where whole life earns its keep. An estate big enough to owe estate tax. A child who will need care for their entire life. Business partners funding a buy-sell agreement. Or someone who has genuinely maxed every tax-advantaged account and wants one more tax-deferred bucket. But notice what those have in common. They're wealthy people problems, and people with those problems already have a fiduciary advisor, not a salesperson. If you're sitting there wondering whether you're in that group, you're not. And take one more step back. Do you even need life insurance at all? It exists to replace your income for the people who depend on it. Nobody depends on your income? You might not need any. Somebody does. The standard rule holds up: 10 to 12 times your income, in term, for the years until the kids can stand on their own and the portfolio can carry the weight. Insurance is a bridge to being self-insured. It was never meant to be a lifetime subscription. Insurance is for protection. Investing is for growth. Anything that promises to do both usually does both badly. For you. It works out great for whoever sold it to you, though. Buy the protection, invest the difference. Let each one do its own job. New breakdown every week. Subscribe so you don't miss it.